Hello traders and investors, this is Sal for Expo Futures, and I'm going to do a quick educational video. I'm going to use this Canadian dollar chart for an example. Today is the 9th of February. It's in the evening after hours, and the Canadian dollar is currently trading around 93.66. Let's call it 93.5. So the two options I'm going to use for this example, as you can see in the trading matrix, these are going to be April contract. Although we're in March and the crowd is in March, I'm just going to use the April because of the time aspect. So just note that both of these are going to be 93 strikes and April contracts on the Canadian dollar. And I'm not going to go over the deltas, the Greeks, or anything like that. The only topic we're going to cover here is going long and short these different instruments, because it's a very fundamental point, very important. Not a recommendation to buy or sell. As you can see, the Canadian dollar has pulled back based on the dollar's rise, and this is the 4-hour chart. I'm going to get this out of the way. So we're looking at about 2 to 3 months. This is December, end of the year rise, and then a sell-off. And it's if you speak in calculus terms, the second derivative is slowing down. So it's not getting worse; it's holding up, which is not bullish itself. And you can see that by the 50 moving average. It was sloping down very fast, and it's slowed down, and it's creating what you could start to make out as a W. It doesn't mean it's going to go up, and we're not recommending anything, but we are pointing out that it could go either way. So depending on your own view, you could buy a futures, you can short the futures, or you can use the options to kind of give you an extra edge. Now, the reason there's no edge is that the volume isn't very bullish. There's this OBV, the on-balance volume, is very weak. So until it gets strong, I can't say with confidence that you should buy something. You should probably look at the 94.70 level, the high 94s, and say, okay, breaking above that, it's pretty easy to say there's a good chance that there's strength and it's rising. So given that, you can do two things. Let's assume there's going to be upside from 95 up to 97. That's in order to take advantage of a bullish move, instead of just buying the straight futures, which can be too risky, let's look at an option. Let's assume upside. So here's the 93 call for April contract of Canadian dollar, and it's trading around 211. So that's about $2,000. Okay, so it's about $10 per tick. It's 2 points. That's $2,000. So 2.11, $10 per tick, 211 ticks. So that means that you get this in the money call. It has a little bit of in the money, but it's still risky because it can go out of the money. So you'd buy this 211, and you'd expect upside, and it'll appreciate minus time decay. Okay, so you may or may not be familiar with time decay, but every day that goes by, since we're renting this futures position, this is a side bet. This option will go up, but there's going to be a little bit of this out of the money value, some of this 211 that will fall off. The alternative to going long the call, I can use this 93 put, and I can short the put. So the put goes up in value as the market goes down. If we don't think the market's going to go down and instead it's going to go up, this is going to lose value, and I won't risk as much time decay. How are they different, you might ask? Okay, well, if I go long the call, I can only lose 211. That's my max risk, and my upside is unlimited theoretically, right? It can go up forever. It won't. It's not likely that it'll go up forever, but it can, theoretically. Here's the 93 put. Now the put, if I'm wrong, it can go against me unlimited, and my reward is only 156. If I short the put, my max reward is 156, no more. I can actually lose, if this actually breaks through 93 and it all of a sudden gets bearish, I'm going to lose more. I could lose more than what my potential reward is. Not the case with the call. So I hope it's not too confusing, but it's supposed to be confusing because it is. It's complicated. After a while, you get used to it. But this 93 call gives you upside. The max you can lose is 211, and you can make more than that. But there's time decay. To avoid time decay, you can short the 156. I'm just reinforcing the concepts, and you can replay the video and make sure you understand it. But these are two different ways to use options to accomplish different things. If I saw a move and potentially it can go to 97, maybe the call isn't my favorite play because it's 94 to 95. That's 1 point. Or one full point on the option, and then two. Maybe I'm only looking for 2 points, and if I'm worried about time decay, then maybe this put is a way to go, and I don't want to stay there too long. If I really thought it was upside, maybe I do go for the call. So just things to consider versus just going long or short the futures contract. If you have any questions, let us know. But hopefully you can digest this information, and it'll give you some ideas to play around with. Other than that, have a good night, and hopefully you'll join us for the next video.